But it also means that it's a very interesting time to have your job looking at this data all the time because the volatility and the rapid changes. But just one question, because we go so directly into the details, but just for people who don't even know how to separate a commodity from a non-commodity, can you just give the ABC lesson of what is the definition of a commodity? Because there's many things people maybe would think is a commodity that isn't recognized as a commodity, right?
Well, whatever comes out of Mother Earth, I would say, to keep it simple for your audience. And then that's obviously not quite true, because if we transform natural gas, methane into, in the Haber-Bosch principle, Carl Bosch and Fritz Haber invented this process to create ammonia, which is the ingredient for fertilizer, one of them, right? Nitrogen is made out of ammonia. So that process, there is a industrial process behind. So, but it's still then when ammonia comes out, it's considered a commodity. So it's now it's oil. It's a little dangerous to define it too precisely, because the moment the real commodity guys are at the table, they say no, but you don't understand. But what comes out of Mother Earth, I would say, and then. Is there one oil? No, there are hundreds of different of oils, sour and sweet, and different classifications that matter to when you and I would work in a refinery. We would look for this type and not that type kind of oil and so on. But it's a commodity, right? And what is, I think, important for your audience to understand is that commodities, unlike equities, they are what I call spot assets, right? They price at the margin on the basis of the physical market. So the market, let's say, today needs 100 million of oil and can only find 100 million barrels, right, of oil today, and it can only find 99. So we have to take one out of storage because we have some storage in this world. Then the price goes up slightly, right? This 1% that we don't find makes the price. And that is true for all commodities. So if we are in a deficit, prices go up, and that deficit is defined at the margin. I think that's the best I can explain it in this format, but please follow us on Twitter where we explain it in more detail at times. And then obviously an outlook matters for commodities too. So for instance, if you are in 2014, where we had too much oil and we were in a surplus, outlook for oil because of what happened, what was going on in the industry that they call US shale drilling, then the price doesn't go up, because even if you have a disruption for a short moment, everyone says, don't worry about it. There is plenty to come. We are not short of it in our outlook. But if you then suddenly go into a period where there has been underinvestment, because obviously this extractive industry called commodities needs constant investment into bringing more out of it. And if you haven't invested enough, as we've done for the last 6 years, almost in anything, in some cases for 10 years, the outlook suddenly becomes of a structural deficit. And then the price behavior changes of commodities too. And then I would say the last layer that probably, in what is commodities, but also what makes the price of commodities, there are technical aspects in there, in the fiscal world, but also in the physical world, but also in the financial world, that can cause prices to move in extremes. So let's explain that quickly, because I think it's very simple for everyone to understand. So remember when we came into the summer 2020, and then we had too much oil. because the world had to stay at home, couldn't use the car, had a completely different behavior for the first time ever since we know oil. Now, so here is the thing about oil: you cannot just get rid of oil when you produce it. You have to bring it into a system which is called storage. And if you run out of storage capacity, as we did, now you have a problem. Where do you put that additional barrel that you just produced? And so again, the price needs to work on that and needs to send a signal and say, stop producing, stop producing. So the price has to continue to go down to the marginal cost of each barrel produced in order to incentivize that the producer, a great family like the Lundin family that runs this, or the Rocke family, Röcke, I think you say, to tell them, hey, stop producing. We don't know where to put your barrels. And the price does that by going below the cost of production, the marginal cost of production, so not the entire Abschreibung, the depreciation of it and so on. And then people, take decisions and stop those. And that didn't happen perfectly, because it never happens perfectly, right? Because everyone thinks like, there are hundreds of thousands of producers out there. And then the Lundin family said, well, we are a $20 cost company. Why don't we let the $50 cost company shut in their wells, right? And then they wait. Rightly so. I would do the same. And then that guy somehow has to pay interest and says, no, but I can use this additional dollar that I made. It's very little, but I need it. And then he doesn't shut in, right? And that's exactly what happened into the summer. And at some point, storage was full. And then there is a pricing hub, which is called, in America, they call it WTI. And we in Europe, we call it Brent. And then there are different prices of oil with different names, so on. But then over there in America, in WTI, there was a landlocked kind of pricing hub where there is storage facility, and this additional barrel came in. Call it an additional barrel. It doesn't matter amounts and details here now, but this additional barrel comes in and no one can take it. So what happens? Well, behind that barrel is a contract, right, that needs to be fulfilled, and someone had to deliver that barrel and couldn't, or someone had to kind of, where do I bring this barrel? Where do I bring it in storage? And he couldn't, because the merchants, the traders said, no, we don't have space for your barrel in our storage system. And so the price collapsed below zero. And you could have helicoptered out that barrel, right? And said, no, I mean, that's silly. Let's take that barrel and bring it somewhere else. But in that one moment, that's going back to the technical aspects, that made the price of oil go below zero. Despite this valuable barrel for society. And so technical aspects in a specific moment can matter. We saw that in nickel 2 weeks ago too. And without going into too much detail, but in general, commodities price of demand and supply. But they also price of the outlook of those commodities. Is there a structural oversupply or undersupply in the world to come? And then there are the third element is call it a technical element, which can cause a lot of price volatility. And I think that's what you're going to see in the months ahead, where we might have the reverse of what we just had in June 2020, where suddenly someone needs the barrel but cannot find it, and then prices overshoot and have nothing to do with the production cost curve of that commodity, but just it overshoots because there is a contract obligation and it cannot be fulfilled, and someone needs to close a position and cannot close it out. And then there is what I would call technically irrational behavior. But I expect more of that to come as we are in short everything. I mean, it's for me, it's at the moment hard to think of a commodity that we have too much of. Iron ore, but even there, I will have to dig in deeper to be absolutely sure. But it's all linked, and we are short of it, and we underinvested as a society for 6-10 years, and here we are.